Welcome back. The question we posed today, could lower interest rates actually send the housing market down? One of our objectives is to serve as a forum for interesting economic theory, market discussion. Hopefully, we can learn something out of all this. Well, the current housing market we can summarize as follows, and we're going to get to the news of the day in just a moment. First off, we have falling sales, very bad numbers. We have low inventory. Now, that's in part caused by the lock-in effect. We're going to talk about that in a second as well as reluctant home builders. And we also have a lack of demand based on the fact that the affordability index is very low. We just can't afford the homes that are out there. Now, first off, lock-in effect. This occurs when homeowners that want to sell are reluctant to sell because interest rates are high. You see, because if they sell, they'd be forced to buy a new house with a much more expensive mortgage, so they decide to wait. Now, today's news, existing home sales tumbled to the lowest level since 1995. Sales of previously owned homes tumbled 1% to an annual rate of 3.78 million units. It marked the slowest pace of sales since August of 2010. So, number one, sales are down a lot. Number two, we look at inventory. This is on a month-over-month basis. Blue bars represent the sales, white line, housing inventory, green line, median sales price. Housing inventory in particular, month-over-month, down 11.5%. We also consider single-family homes, month-over-month. Housing inventory, down 13%. So the inventory is drying up. Two reasons: the lock-in effect. People don't want to sell and roll themselves into a higher interest rate mortgage. And the home builders read the economy and they say they don't want to build a lot. Now, existing home sales, this is the number of units, and this was the headline reported 3.78 million units. This represents the lowest level since the 1990s. We can see this is the lowest level we've seen in a very, very long time. There just is not the volume of sales out there. Did this ever happen before? Well, what we can learn from history will go back to the new home sales in the early 1990s. First off, let's take a look historically to see, in terms of the median sales price, this has declined quite a bit. First off, we look at the late 1960s, early 70s, we had a period of time of negative 15% sales prices. We then see 2008 recession. We know that affected the housing market in a very negative way, down 15%. Well, on a year-over-year basis, we're currently at 16% negative. So the median sales price is down quite significantly. Now, as interest rates decline, home prices decline. This is in the 1990s. We can see left-hand side of the chart, 9.8. That represents the interest rates coming out of the late 1980s, if you can believe that, 1989. The blue circle is 13%. That's the median sales price, the increase year over year. That's how much the median sales price went up on a year over year basis. Well, notice what happened when the 9.8% interest rate dropped to 5.75 interest rates. The 13% median sales price year over year dropped to negative 7%. This doesn't make sense. If interest rates go down, shouldn't sales prices go up? Well, the fact of the matter is, it didn't in this case, and that is a theory about what we're talking about today. Also, as interest rates decline, the number of sales decline, the velocity of sales, the number of homes actually sold. Well, that doesn't make sense. On the left-hand side of the chart, 9.8% interest rates. We had at the time, year over year, 8% growth in terms of the single-family homes sold, the number of homes sold. Well, as interest rates went from 9.8 to 575, we went from 8% single family homes sold year over year to negative 35%. Again, doesn't make sense. If interest rates are going down, shouldn't we be selling more homes? After all, the mortgage is cheaper. It's more attractive for the home buyer. As interest rates decline, inventory rises. We see here 9.8%. That's the interest rates. 8% to the negative. That's the monthly supply. And then we see as we went from 9.8 to 575 interest rates, the supply went through the roof. And that is really opposite of what we're seeing now. Right now, we see very low inventory. But this is the idea that when interest rates, the Federal Reserve is expected to cut rates maybe in March, maybe in May. And when they do, I think most assume that the inventory will go down, that sales will go up, that prices will go up. But this is actually counterintuitive. The lesson we learned from the late 1980s, early 1990s is that when they cut interest rates pretty drastically, supply actually went up and sales went down. Why is this happening? As the Fed cuts rates, homeowners rush to the market, driving prices lower. You see, remember the lock-in effect. We want to sell, but interest rates are high. Let's say tomorrow the Federal Reserve cuts rates. Well, then we can rush to the market. We have lower rates. We can buy something else with the lower rates. So the homeowners will rush to the market, driving prices lower, and they'll get to the market faster than the economy can improve and create new buyers. You see, the purpose of the Federal Reserve cutting interest rates is to stimulate the economy, to add liquidity to the economy. But that takes time. The Fed cuts rates, businesses feel more confident and comfortable. They hire more, we get jobs, we get bonuses, then over time we decide to buy a house. But that happens after the fact. The first thing that happens when interest rates come down is that when you have a period of time of very high interest rates and there's sellers that are locked into the market, well, they want to get to the market first. So the sellers get to the market before the buyers do. That's why before prices go up, they actually go down. Now we see, going back to the 1990s, and this illustrates exactly what we're talking about. In late 1990, 127,000. That was a median sales price for a home. 9.4, that's the monthly supply. That means how long does it take to get rid of the entire month's worth of the entire inventory, so to speak? It would take 9.4 months. Well, as interest rates, you see the 7.5, that's interest rates December of 1990. As interest rates went from 7.5 to 4.0, the green bars, the sales price went from 127 down to 117. The inventory did drop as well. The inventory to some extent was absorbed at that point. But the fact of the matter is prices went down because more sellers ran to the market faster than the buyers did. Present day, what do we see? Green line represents a median sales price, white line monthly supply, blue line single family homes sold. Well, sold is a little bit in the past tense, but nevertheless, we see this is the current trend that single family homes sold is going down. There just aren't a lot of homes for sale. The median sales price, it is ticking up, and it's ticking up along with the supply to a small extent. But notice the white line going back to the left-hand side of the chart, starting November of 22. The supply has come down quite a bit. So as supply comes down, it's supporting the sales price. If there were more homes for sale, then the sales price certainly would go down as well. Now we see also another factor, the housing affordability index. And that is in blue over here. The white line represents single family homes sold on a year-over-year basis. Now, what do these numbers mean? If it says 100, it means that the average home buyer can afford the average home in the country. However, when the number goes below 100, it means those average home buyers can afford less than the average home, that the homes become unaffordable. And we see right now, over the past, year or so, this is the lowest low we've seen, at least in quite a while. And that correlates pretty strongly with the single family home sold. You see, inventory's low, sellers don't want to sell, and in addition to that, these homes are just less affordable. So there's really conflicts of a lot of different things going on at the same time. Well, tell us what you think. Again, one of our goals here is to serve as a forum for inquiry and discussion about economic theory and market trends, and everything in between. Let us know if we got this right. If you haven't already, please visit our Substack newsletter, The Inverted Bond Market, Where Are We Now? We discuss inverted bond markets, how markets behave during and after those phenomenon. And also, you can visit our inverted bond market as well as the other articles at substack.com, absolutely free. Just simply enter in our name right here, Just the Data. As well, please visit our Twitter page, Just the Data. We hope this has been helpful. We look forward to seeing you back soon.